Hi, everybody. So, on this episode, I want to talk about prepaying your mortgage. Okay, so for those of you who buy a house or are thinking of buying a house, I just want to talk about what I see as the pros of making prepayments. You could probably Google this, and I highly encourage you to do so because as you're thinking about how you're going to do your money management, how you're going to plan for all of this, it might be something you want to research. It might be something you want to look at and get different opinions about. Um, and I will tell you that um, I learned about this originally. Um, I was a late purchaser of a house. And I saw my father do the same thing. My father bought a house much later in life. Uh, he had owned stuff before, he had rented places and all that kind of stuff. He had bought like a double wide trailer at one point in time, and he didn't have a huge um, loan on that. But when he bought his very first house, um, he was 55 years old. And so when you think about a mortgage, and typically they're 30 years, um, that's that's a long time. I mean, you're looking at if he didn't make any prepayments on the mortgage, he would have been paying on that for 30 years or 85. Now, my dad died at 77, so um, that can be a little daunting at that juncture in life. But here's one of the things that he did, and I saw him do it. He didn't necessarily tell me that I should do this or anything like that. Um, but he worked for a company where he had, I think, by the time he retired, he had something like 4 or 5 weeks of vacation, and he had had that for a long time. And so one of the perks of working for this company was you could sell your vacation back to the company. So they required you to take a week off or something like that. I think it was a week you had to take off. But you could sell any unused vacation time back to the company. So he would sell 2 or 3 weeks of his vacation every year back to the company, and he would get a check for that. They would compensate him for that. And so I remember him saying one day, he said, I put that entire paycheck as a prepayment on his mortgage, and he did that for several years. Now, I want to preface this by saying I think that my father's very first house he ever bought was $125,000. In today's market, uh, that's like what? It's so cheap, right? So everything is relative here as far as what I'm talking about. But I'm also going to talk about my experience with doing this and why I am making prepayments, why I see there's an advantage to that. Um, and again, seriously, this is what your notebook is for doing your own research, looking at all the pros and cons, deciding what is best for you. Okay, because that's the bottom line. You got to decide what is best for you. And for some of you may never buy a house, so this would be a moot point. Um, so when I decided to buy a house, I was 50. I was 50 years old, so 5 years younger than my dad, but still, I'm looking at a mortgage that wouldn't be paid off if I didn't do prepayments. Wouldn't be paid off until I'm 80. I don't know if I'm going to last till 80. I have no idea. Uh, but um, I've also uh, refinanced my house because when I first bought the house, interest rates kept falling. And so I actually, in 2020, I had already refinanced it once, but I refinanced it 2 times in 2020 because interest rates got so low. Um, And I think my mortgage is like 2.75%, which uh, is really low. Um, but even with that, the total interest, if I don't make prepayments, is going to be pretty substantial on my loan, on my mortgage loan. Um, so one of the first things that I see as an advantage, of course, is that you can pay it off in a shorter period of time. So if you're closer to retirement, like I am, I'm much closer to retirement. I don't want to be paying my mortgage in my retirement. I just don't. That's part of my plan of trying not to have that. Now I'll still have to pay escrow. I'll still have to pay, the insurance and the property taxes on the house, but I won't be paying the mortgage payment. That's my plan. Is that I won't have that to worry about. And so for me, I'm trying. That's one of my goals. Is that um, with the prepayments I make, I can get it to where I don't have to worry about it in my retirement. So I've got another, if I retire when I want to, I have another 7 years to make that plan a reality. So my father, because of him selling back that time, uh, plus I think he might have made some other prepayments on his house, he paid it off in 15 years, which, on a $125,000 loan, I could see that would happen. Now, my townhouse, of course, by the time I bought one, at age 50, my mortgage was about 3 times that. Um, Now I've refinanced it a couple of times since then, since that original loan, etc. But I'm still on pace to hopefully do what I want to do. All right. So one way you can play around with this is that if you go out and Google, look up a loan amortization schedule template in Excel, something along those lines, and you should be able to find something that will allow you to put in your loan amount, your interest rate, your loan period in years, and it should give you a schedule of the payments that you will make. And the reason you want to look at this, and what I'm going to illustrate on this episode, is how these prepayments can help you. Okay, so right now I have a loan amortization schedule that I pulled off of Google years ago. And I have put in a loan amount of $500,000 with an annual interest rate of 5%. And this loan would be paid over 30 years. And I'm just using random numbers here. So it's coming up with a scheduled payment of $2,684 and some change per month. Okay, over 360 payments. All right, now this is not assuming any prepayments at all. All right, so one of the things I want you to see here, which is true of pretty much any loan you get from a bank, pretty much any loan you get from anywhere, is that your payment, that scheduled payment of $2,684.11, that payment, a portion of it is going to go towards paying down your $500,000 loan, and a portion of it is going to pay interest. Okay, so that very first payment that you make, according to this loan schedule, that very first payment you make of $2,684.11, over $2,000 is going to go towards interest payment. Okay, so banks front load the interest payments early in a loan so that they can get a lot of that interest, because they anticipate that people will potentially prepay things. So it's definitely not like an even interest amount that's paid every month. It's heavily weighted towards the beginning of your loan. Okay, so when you think about it, it's like, okay, so that $2,684.11, that mortgage payment, only $600.77 is going to go towards principal, paying down that $500,000 balance. Okay. Now let's put this in context. So according to this schedule that I'm looking at in front of me, that $500,000 loan, if I don't make any prepayments, if I make zero prepayments and I pay it off over 30 years, I'm going to pay $466,000 in interest. That's more than my loan amount. Is that not crazy? So essentially, if I don't make any prepayments, the bank is getting well above the original loan amount in interest payments. Okay. So now let's see what happens if we make a prepayment. Okay. So let's assume that you are a salesperson or you just work at a company where maybe you get a bonus each year of some amount. And I'm going to assume a fairly hefty one, right? Just so you can see kind of what happens here. But let's say that you get that typically in December. It's part of like right before going into the holidays, you get this bonus, blah, blah, blah. So let's assume it's going to be $10,000. Okay. So in December of the first year of this loan, I'm going to put into this spreadsheet here a $10,000 bonus that I'm just going to put all of it as an extra payment on this mortgage. Okay. All right. So I'm going to enter that in. All right. Now, something amazing has happened here. Okay. So originally, the scheduled number of payments I was going to make was 360 payments. Making one payment of $10,000 towards prepaying this mortgage within that first year of the mortgage. So essentially I have stated that this mortgage is starting on March the 1st, and I'm putting in a prepayment, an extra payment that's going towards the principal in December for $10,000. The actual number of payments I'm going to make now, if I make that payment, is 345. Okay. So I have knocked 15 payments. I have knocked off over a year's worth of payments that I would have to make at the end of this loan period. Okay. So instead of 360 payments, I will make 345 payments instead. Okay. So, and instead of paying the bank $466,000 in interest, I will instead pay the bank $434,000 in interest over the loan period. Okay. So not only have I knocked 15 payments off the schedule just by making that one lump sum payment as a prepayment, I have also saved myself $30,000 in interest. To me, that's worth it. Okay. So essentially, what I do every month, I throw whatever extra I can throw onto making a prepayment. I try to make it, maybe $200, maybe $300, anything will do, So for example, on this loan schedule here that I'm playing with, so if you find yourself a loan amortization schedule, you can kind of do the same thing. You can follow through this same example, right? So if this is starting on 3/1 and I make not only the regular mortgage payment, but I also add, let's say, $300 to that, okay? Just that very first payment, if I put $300 on that, that didn't change a lot about my overall loan period. although it dropped the total interest by about $1,000. Okay. So that $300 leveraged me by $1,000, as far as like saving interest. Okay. I'm going to put it $300 on the second payment. Okay. And that saves about $2,000 in interest. Okay. Um, I'm going to just put $300 extra on like the first 6 months. See what happens here. Okay. So that drops my overall loan period from 360 to 358 payments, but it saved me over $6,000 in interest. That's amazing. Okay. So for me personally, I'm trying to save as much interest as I possibly can on my home loan. And as you can see, if you've got a $500,000 mortgage or more, you're spending a hefty amount and making the bank richer, which, you know, maybe that's fine. And you don't have to make prepayments every month or anything like that. That's, this is just up to you and what you can kind of figure out over time, kind of what your plan might be. But like any extra money that I can throw at this, I throw at it, because you can see how much interest it will save me in the long run by doing it. Okay. Now, eventually, it could be that maybe I don't make my goal. Maybe I'm not able to pay this off. But let's say by the time I retire, let's say that my loan is down to $200,000 or less. What if I refinanced it? My original loan had a mortgage payment of like $1,700 to $1,800, something like that. And if I mortgaged $100,000, just think of how small my mortgage payment would be. There are all kinds of different calculators out on the web that you can, throw in numbers and all of that. It would be substantially lower than where it is right now for me. And so that could be my backup plan B, where I just refinance a much lower mortgage amount. I'll have to decide that as I get closer to retirement, if I haven't met my goal, but I'm planning on making that goal. Okay. And so we'll see how it goes. So anyway, it's keeping an eye towards how small can I make my expenses in my retirement and manage all of that, and basically not spend double what my mortgage originally was, because when you add in all the interest payments, it's a lot of interest. Okay. All right. So hopefully I've given you some information for you to think about, to research on your own, to kind of think about your own situation. Look at opposing opinions. Look at opposing opinions about this, because not everybody's, keen on doing this. You can also look at 15-year mortgages, but if you, and you can even put into this loan amortization schedule what a 15-year schedule might look like. But you're talking about doubling the size of your payment. But yeah, you could pay it off in 15 years, right? So doing these prepayments is also another way of doing that. If you can't afford a 15-year amount, because if you put in 15 years instead of 30 years into this, you'll see that instead of a 2,684 mortgage payment, probably double that, maybe a little more. I don't know. I'd have to put it in here to see. But those are the kinds of things you want to play with, because you've got these different variables that you can change. If you can get a decent interest rate, what your mortgage is going to be. If you do a 15-year, 30-year mortgage, and of course, with this particular template, and hopefully with the template you find online, you can put in these extra payments and see how much you can save over time. Okay. And especially if you've got a time frame that you want to hit to be rid of your mortgage part, your property taxes you'll still have to have, and you'll have to still pay insurance on your house. But without a mortgage, you might be able to pay those directly. So anyway, I hope this helps. If you have questions about it, you can always ask, and I'll talk to you soon on another video. Thank you.